Let me begin by saying that I think we are living through remarkable times. We all are very fortunate to be living in the midst of a time of more disruption, innovation, and new technologies than any other humans have ever experienced before. And that is profound, and I'll talk to why in a moment, but it's very profound for organizations like Singularity, whose mission is to help the world become a better place through the application of exponential technologies. But it's also a time of great uncertainty, and for some of us it's also a time of great fear. And I know that for some of you, it's a very challenging time, and for investors specifically, a lot of the things that we know are turning out to be questionable. If the actual industry may not exist beyond 10 years. So it's a good thought process to ask the question, what does this new emerging area of technology imply for investment decisions? So that's what I'm going to do. So I'm going to start off in the past, and I'm going to do this very quickly, but this is not the first time the world has passed through a time of extremely disruptive innovation. We've actually done this at least 4, maybe more times. And just to give examples, going from the agrarian period to the mercantile period, we saw massive disruptive innovations, long-distance navigation, cartography, the age of the rise of maritime transportation on a massive scale, risk sharing, joint venture stock companies like the East India Company and so on. And when we saw that, enormous wealth got created. That wealth accrued to new people. And in fact, what we saw in that transition from the agrarian to the mercantile era was that the basis of wealth that had been land owned typically by tribal leaders, emperors, and kings, was transitioned over to mercantile states, cities, princes, and princesses who basically became the wealthiest people of that era. And we saw that again going from the mercantile period to the industrial era. 200 years ago, steam, mass production, electricity eventually, all of these things drove a new phase, and once again, enormous wealth was created, and once again it transitioned to new sets of people, in that case the industrial tycoons and the financiers that backed them. So this theme that disruptive innovations, when they arrive and when the world shifts, unleash enormous value, but that value is not necessarily held by the incumbents, is something we've seen before. I mentioned that we are now living through another of those phases, and all of the work, and I'm not going to go through it today, but all of the work of Singularity is focused on this moment. The exponential technologies that many of you have learned about when you've visited or attended Singularity events are really driving a new transition. Things like artificial intelligence, the internet sensor revolution, and now the Internet of Things, clean technologies, life sciences, all of these are hitting at the same moment in time. And we're seeing dramatic shifts in industries, in businesses, in how people make money. We call this the fifth era. I know that Ray and Peter have a view that we're eventually going to get to a Singularity event. Regardless of whether you believe that, the reality is right now the industrial era is coming to an end, and we're moving into a new connected and technology-driven world. I said that wealth shifts, and I've got just 3 measures of that. I think you're all aware the world's most valuable companies are all now technology companies. That's a dramatic shift. 10 years ago, this was a list of state-owned energy companies, massive financial services businesses, pharmaceutical companies. None of them make the top list today. It's the Amazons, the Facebooks, the Apples, and in China, it's the Alibabas and the Tencents. If you look at the wealthiest people, and this is a list of wealthiest Americans, this list historically was populated by multi-generational families, the Carnegies, the Rockefellers, the families that really benefited from that industrial revolution. Today, it's a completely different list. 70% of the people on the top wealthiest list in America are first-generation wealth. And 70% of them made their wealth because of technology businesses. The Gateses, the Zuckerbergs, the Ellisons. This list reflects the accumulation of new economic pools and the opportunity to take advantage of those, in this case by the entrepreneurs. And this is the last 25 years of US annual returns. It's very similar in the UK, but this is the US chart. And it's, once again, this is the same story, just viewed through a different lens. This is the investor lens. So bond indexes, 3% returns over the last 25 years. You probably destroyed value after costs if you invested in fixed income. Most optimum portfolios would have maybe 40%, 30 or 40% allocation to fixed income. The long-term public equities, 10 or 11% over the same time frame. And then we have the blue bars. The blue bars are the venture capital indexes in the US. The average is 24% IRR, but that hides a lie. That hides a reality, which is that the VCs make a very low return in late-stage VC where they put most of their capital. They actually make probably the world's highest return in early-stage venture capital, but they put much less capital to work early in the process. So once again, another way of highlighting that point, that when disruptive technology changes the world, the returns are captured early. The reality is this rising tide that is carrying all of these ships, these new businesses, these new economic opportunities, is being missed by most investors. And there are reasons for that, and I'm not going to spend a lot of time on this because I know we want to get to blockchain. But in a nutshell, not only are all of the tools that we've inherited from the last 100 years becoming a little bit questionable, as I pointed out, net present value, discounted cash flow, really under attack. But it turns out the entire wealth industry is an industry that exists to access fixed income, public equities, and large cap real estate. And most of those players and most of their platforms have no access to emerging technologies, which for investors raises a challenge. If you want to go through the normal process, you run into vested interests which would prefer your money to stay on their platforms, and their platforms are not fueling exponential technologies. And then there's a lot of misinformation, and that misinformation typically is around the risk-adjusted returns of these other asset categories. So now let's talk about blockchain. If I had been up here 4 years ago, actually blockchain wouldn't have even been on the list. So this is a new phenomena. As a result, everything that's about to follow is work in process. I think each one of you, and certainly I, are still trying to understand this space. I hope to get as much out of tonight as I hope you will, and we're going to have some audience participation in a few minutes as well. But it's a new space. The rules are being written as we speak. I'm not sure that any of us know the answers to investing in blockchain and crypto, and many of us don't even know all of the questions we should be asking. So this is definitely a space in development. Nothing that I say tonight should be taken as recommendations or advice for you. You need to make your own investment decisions. In order to talk about blockchain and crypto as an investor, I think it's very useful to unbundle the conversation. And this we've found as being a good first starting point. So first, we have blockchain and the technologies and the stack being built on top of blockchain. This is the protocol. This is this notion of an open distributed ledger. And it's a very big idea. It's a very big idea because several thousand years ago, humankind took a decision that made almost all economic and financial activity take place on closed, private ledgers. And so if you want to borrow money from me to fund a real estate project, a property project, a lot happens. I have to talk to my bank. My bank talks to me about whether they believe this person is creditworthy. You talk to his bank. Maybe you check credit rating agencies and other things. Then we have to check that the project you're proposing is real. and that you have the rights to that project. And so we have to go to various ledgers, maybe municipal government ledgers, to check that you actually own the property and that you are free and clear to do whatever it is you're saying you're going to do. A lot of parties get involved, and proprietary closed data comes into effect. McKinsey estimates that the dead weight loss of all of that interaction can be 40 or 50% of the total costs of the transaction. It's just extra steps that occur because of this fact that so many participants get involved. The big promise of the protocol is that by allowing for potentially open and potentially distributed blockchain ledgers, we take out the need for all of those steps to occur, but we also greatly accelerate speed. So it isn't just that we took out cost. We allow things to happen in real time instead of that little dance I described that could be a 1 week, 2 week, or even longer dance to check all of the boxes and get everyone to respond. So that is the protocol. I'll talk more about that in a moment. Then we have this notion of cryptocurrencies and crypto assets, which are essentially applications built on top of the protocol. Now, what's a little confusing was that we heard first about Bitcoin, and Bitcoin is an application of blockchain technology. But in order to create Bitcoin, the blockchain protocol had to be invented. Normally, it works the other way around. So with the internet, first we created TCP/IP, and then we started building a stack on that protocol, which eventually included apps like a Gmail or a Facebook. So in the case of the cryptocurrencies and the crypto assets, what we're really talking about is digital software built on top of blockchain protocols with various functionality. And that functionality is multivariate. So you hear about security tokens. That's one aspect of a piece of software. It's recording the ownership of an asset. But we also have transactional activities that these tokens can perform. And so they can have a transactional or a payment functionality to them. But they can also be a smart contract that unlocks. So it gets quite complicated quickly because they're software. The other part of that, and the implication of that too, is that if there's one thing we've learned about software, it's subject to technological obsolescence. And so if I asked you, those of you who are old enough to remember, to describe DOS, many of you would know a bit about it. It was green on black letters that you had to type in to make your computer work. It was actually the dominant operating system of its period. And then IBM did a deal with Bill Gates, and they moved over to the Microsoft operating system, and DOS was forgotten. It suffered technological obsolescence. It had global awareness, a massive community of supporters, a massive network that was built around it, and it went away. And so as we talk about cryptocurrencies and assets, understand we're only 2, 3, 4 years in for most of them, and a lot less for some of them. And so we don't yet know who the winners are, and we don't know what technological obsolescence in cryptocurrencies and assets will look like. And then the third aspect is the notion of the ICO. The ICO is fundamentally simply technology-enabled crowdfunding. It's an approach to raising capital and attaching that capital to, typically, a token which is connected to a crypto asset. So it's a form of investment. Now, I've unbundled this for reasons that will become clear in a moment. Just a moment more on the protocol. When we created the internet, actually 40 years ago, though it really got kicked off 20 years ago, there was a family of protocols of which TCP and then IP were the ones that really, really allowed the internet to begin, the sharing of information. All those other protocols are communication protocols. In other words, they allow far-flung points on a network to communicate with each other. They're rules and standards. So the internet was built to be a communication platform. It was never built to be a transactional platform. And this is a very profound point, and Milton Friedman said this way back in '99. For the world to transition to a digital world, we need a digital system that is both communicating and transacting. Because almost everything human beings do involves economic and financial transactions one way or another. So the internet we have today was not built to facilitate transactions. And in fact, almost all payments and transactions occur outside the internet right now. So bringing them into the internet requires digital or e-cashes or currencies. And that is the great promise of things like Bitcoin. Can they be within the native currency of a digital world, as against a fiat currency, which is an industrial era form of a way to transact value that was not built to be digitally leveraged and utilized globally. I have a couple more pages to do before we get to our first exercise. But this is another profound difference, and this is a lot of why, as investors, we're so excited this time around. When TCP/IP and the internet was created, the protocol was for free. Stanford, and then DARPA, and MIT, and some others created a set of standards, and they gave it away. You couldn't own TCP/IP. If you could have owned 10%, 20% of TCP/IP and all the activity and stack built on it, of course, that would have been unbelievable. You'd own 10% of the internet. But it wasn't available for purchase. In blockchain, the protocol layer, the protocols are actually owned by someone. Communities of people, individual groups of people, they own those protocols. So whether it be Ethereum or EOS or Bitcoin, there is a transaction occurring at their creation which allows some people to own them, but most of 8 billion people to not own them. So even the most decentralized blockchain protocols are actually very concentrated in their ownership relative to the notion of 8 billion people all having a share. Now, one day, maybe we'll get to that nirvana where these protocols have been truly decentralized and every human being owns a piece. But that's not what is happening now. Right now, there is a operating system war kicking off. And so we have EOS, and we have Tron, and we have Neo, and we have Ethereum, and they each are competing for somewhat overlapping opportunity sets. And we don't know who the winners will be. But what we do know is enormous value is being put into play, and some people are trying to own that value. And this is the last page of background. This is about applications. And the other great promise of blockchain is it seems to have, and I underline the seems, a lot of potential use cases. Personally, I'm absolutely of the opinion that money management, micropayments, wealth storage will all be technology enabled by something like blockchain, because it makes no sense for as an example, most international money transfers to occur on a 1970 era platform called SWIFT that drops 6% of the transactions every week. It's broken. So we know that it cannot be SWIFT. We know it has to be something else. And as bankers, and there's a number in the room, as they begin to get to grips with this, they're all beginning to say a native e-cash-based real-time, zero-cost international payment system has got to be better. So I'm absolutely convinced about those. Personal identity is a huge one that needs to change, because identity fraud and everything that goes with that in terms of criminal activity and the like is rife, because none of us really know who the other is. In America alone, we have 6,000 agencies that have different formats for birth certificates. So we actually have a fake birth certificate machine in place in the US on a massive scale, and that has to change. How it will change is a political issue. On the other side, there's a lot of other potential use cases too. The general feeling is the more complicated the use case, the more parties, the more legacy activity and business process, presumably the harder it's going to be to attack those systems and get them to change. So the pace of change and evolution in highly complex settings is probably going to mean these are multi-year, not multi-month, maybe even multi-decade rollout plans. All right, this page is the last one I'm going to present before I ask you to do some work. So this, if you haven't taken too much attention to this moment, now you need to pay attention because I'm going to give you some work to do around this framework. If anyone has a better framework, I'd love to hear it at the end of the night. This is my best stab that sort of is beginning to pull apart the investment opportunities. So what I've got here is blockchain, the protocol, the stack, and the family of startups and new businesses being built on it. And over here, I have crypto assets, and I broke them out. These are cryptocurrencies, crypto assets and tokens being built. They are actually built on this stack, but I think they're sufficiently different that I broke them out. And on this axis, I have traditional funding approaches we all understand: venture investment, equity, common stock, preferred stock, debt investing, but it's also things like ETFs and indexes and other things. And up the top, I have these new emerging fund approaches, which is primarily about ICOs and altcoins being offered through technology-driven approaches. So in the bottom left-hand corner, what I've got is something we sort of have seen before. We have direct investors, angels and VCs. We have VC firms like Blockchain Capital Partners, which is a dedicated blockchain venture capital firm. And then we have the emergence of some fund of funds, all of which are sort of taking a long-term investment view to this emerging area of technology. They're backing teams and companies, and they're trying to stand up viable businesses, either that leverage blockchain or that provide supporting infrastructure for the things that are being unleashed. So I view Coinbase as an example of a piece of infrastructure that is necessitated by and is taking advantage of the explosion of crypto assets. So it doesn't necessarily have to be based on the blockchain itself, but obviously it's adding functionality that the ecosystem requires. So that's what's in the bottom left-hand corner. The bottom right-hand corner, again, is stuff we know. One day it will be ETFs. Most public equity investing in the world today occurs through ETFs, exchange-traded funds. They haven't yet been approved for this space. So what we've actually got are some baskets and indexes, such as Bitwise, but there's others. Coinbase has one, and other people are exploring them, which allow you to buy a bundle of crypto assets. And some of them are very large bundles. In fact, Bitwise has Bitwise 10, 30, and 70. So 70 is a diversified portfolio of 70 crypto assets. So this sort of stuff we understand. The top right-hand corner is engendered by the cross-section between the ICO world and the crypto asset worlds. And this is the creation of and the investing in crypto assets in new platforms. So, for example, Binance is a new platform, only 2 or 3 years old, and you can go to it and you can buy crypto assets and buy and sell them on that platform. But from an investor point of view, it's not just that you're buying a new product, a new token, but you're buying it through a new player, Binance, on a new platform, the Binance platform. And so as an investor, we've got multiple tiers of risk because we've just gone into a new space on multiple dimensions. So that's in that corner. But there's other stuff in that corner too, such as crypto hedge funds. So what's sort of happened is in the world that we understand, the derivatives markets are vastly larger than the underlying asset markets upon which they're built. And the hedge funds and similar products are much more numerous than the underlying assets. Okay. To be specific about that, in America we have 4,500 public stocks. We have 10,000 mutual funds and ETFs, and we have 16,000 hedge funds and similar vehicles. So we have a lot more derivative products than we have underlying assets. And there's many different strategies. There are short strategies, long strategies, hedge strategies, algorithmic trading strategies. There's many, many strategies. Those people, whether they're in London or in Wall Street or somewhere else, are saying Now we've got a new asset class, crypto assets. Can I make money by applying what I understand already in terms of strategy to these new assets? And so they're setting up crypto hedge funds, okay? And so that's in that corner too. Why is it in that corner? Because the underlying assets are new to the world, and then in most cases they're new firms, and their strategies are unproven strategies in these asset categories. I'll give you a specific example. We don't yet know what the correlation of crypto assets is to traditional assets. We don't know it because we haven't had a crisis since 2008, and all of these assets were created in 2008. So you'll hear people say things like, oh, crypto assets are negatively correlated with X, Y, or Z, but no one knows, because you have to go through multiple cycles over a long period of time to be able to calculate your cross correlations. So we don't know. And then the top left-hand corner is really what is security. It's now, I would call it security token investing. So either directly buy some tokens in a blockchain business, setting up a community and asking you to buy some security tokens in that community. And then there are some funds, and I gave the example of Pantera ICO's one, but I think Polychain is up in that corner, and there's a bunch of others. Here in Europe, 1KZ would be an example of a fund in the top left-hand corner. So this is the playing field. Now, I may not have it 100% right, but I think it's good enough for you now to do some work. And the question is, and by the way, Mitesh, are we doing the big groups or the two-person groups?
Two-person.
Two-person groups. So what we're going to give you now is about 10 minutes, 15 minutes, to pair off with one other person. You have $1 million, and just intuitively, where are you placing that money? And then I'm going to debrief the group. But you've got 10 or so minutes to pick one person, and just intuitively, where would you place your $1 million?